In the first Monday call of 2023, our investment team, James Grigger, Mark Brooks and Andrew Curtain, join us to discuss key market developments and the drivers of returns for investors. Are better than expected US and New Zealand job numbers pointing to a soft landing or even no recession? Does the Federal Reserve slowing the pace of its interest rate increases mean inflation is being tamed? How should we interpret the recent negative business and consumer sentiment when other data points seem positive? And after a year of big market shifts, where are New Zealand funds portfolio managers seeing the opportunities for investors? This is the Monday Call, brought to you by NZ Funds.
Hello and welcome to the Monday Call, the first one for 2023. In December last year, we discussed the big events that impacted financial markets in 2022 and the potential opportunities we saw for the year ahead. Some 8 weeks later, not much has actually changed, but actually a whole lot has actually changed. And so we thought it would be a great way to kick off 2023 with an outlook of where we think financial markets are going for the year ahead, knowing over the last 8 weeks that things can change dramatically over a very short period of time. So as the eye of the storm of Cyclone Gabriel comes ever closer to Auckland, Andrew, portfolio manager, and Mark, head of income at NZ Funds, is joining me today to discuss events. And as you can see, we're a little bit rusty at the start of the year in terms of the smooth, run into what will be a really interesting year in the sense of what happens to financial markets. And I guess one way that we've thought about explaining our thoughts is going over the key themes and outlooks for the year. I'll briefly mention them and then perhaps we can jump in one by one into what they look like. So I'll rattle them off and we'll go. So theme one is peak inflation is behind us, but the hard part is likely to come. Theme two, we are paid for owning assets again. Theme three, economic and corporate slowdown. And theme four, the commodity super cycle and China reopening providing that catalyst. So a lot of these themes, team, are very similar to what we've been talking about, I guess, all of last year. But some of them, I guess, a bit more influential in what's going on in financial markets. And I think one that's been around us, I guess, ever since really COVID and coming out of lockdowns and the amount of capital that was pumped into the market and the economy from central banks and governments is this inflation theme. What's happening? Where is it going? And what is it doing to financial markets? It's a really open-ended question. Who wants to kick off first and talk a bit about inflation? Andrew, do you want to introduce the theme and then perhaps we'll get Mark's comments on where interest rates and perhaps what the Fed and Reserve Bank's thinking?
Sure. Good morning, everyone. It's great to be here again talking to you. I'll have the first comments, but I'm sure we've all got a few thoughts on inflation. So chip in when you're ready, Mark. So 2022 was a year that was really dominated about how high inflation could go. Inflation was accelerating in pretty much every economy you looked around the world, including New Zealand, Australia, the United States. However, we started to see signs in most countries, and certainly in important countries such as the United States, that inflation has peaked. And so while 2022 was about how high inflation could go or where that sort of right tail risk could be, 2023 looks more to be how long is it going to take to return to a normal level. So just to give you a couple of numbers of some context here, in the United States, we started 2022, so the start of the year, an inflation number of around about 7% year on year. Now that's come up from levels that are around about 2 to 3% historically. We peaked around about the middle of the year at 9.1% year on year inflation. And the latest data point we got, which is for the December month, is down to 6.5%. So we're seeing that sort of almost 3% retracement from the peak level, which has given investors, or pretty much every investor, the confidence that we're seeing the peak inflation for the cycle. But the question is, how long does it take to come back down? And I'm sure Mark will have a few thoughts on this, but if you go and look at sort of historical analysis, Mark, it tends to be tricky to get inflation down to that kind of 3% sort of or sub 3% level where you've still got very tight labour markets and sort of no slack in the unemployment rate.
Yeah, something we talked about a couple of times, I think, last year was that difference between goods inflation and services inflation, or in New Zealand they call it sort of tradables versus non-tradables. And goods inflation peaked. It tends historically to be very peaky. So by that I mean, clearly, if you want something and it's not available, people are often willing to pay up for it a lot. So the prices move in fact, very quickly. And we did see goods inflation in the US, I think, peak at over 12%. But clearly, with the world returning to more of a normal state, to supply chains returning to normality, and certainly we've seen it in terms of shipping prices. They're back, I think, below 2019 numbers for the US.
Around about to the level of the pre-COVID level.
Yeah. So you've actually seen that goods inflation. In fact, we are sort of bordering on goods deflation almost in the US in parts. So that's about sort of 40% of the US CPI. So if that's coming down fast and even deflating, headline inflation is coming down. But your real challenge becomes the services side. And with services inflation running over 5%, you have historically that's taken a very long time to come down, and that's one of the challenges that we see for this year is that you've seen the easy part. Going forward, there's going to be some reasons as to why it may be a bit more challenging to come further.
Does services inflation include wages? Because that's the big discussion point at the moment, isn't it? And what's happening with wages and the unemployment rate and jobs, especially in the US.
Yeah, exactly. In the US, they also have housing and housing-related costs make up quite a large bit. So from that point in the US, housing costs are coming down, but haven't really come down yet from in the CPI data. So we'd expect that to sort of continue to soften as we go ahead, but certainly wages really are the focus, I think, for everybody. You've seen, in New Zealand and really around the world, actually employment data remain remarkably robust. And it's a slightly sad fact, but to get inflation down, you need to reduce demand. And by reducing demand, that tends to reduce demand for labour and pushes unemployment up in terms of I suppose the steps the economy goes through. And, so far we haven't seen that. You've seen generally very strong labour markets and that sort of kept I suppose, the thought process there is that's likely to keep the pressure on wages.
We talked about it at our December monthly review that we sent out in January about this Goldilocks of the central banks, especially the US Fed, are able to bring down inflation, but unemployment really not rise that much, and actually we're not going into recession. Has that ever been done before, and do you think that's possible?
As to whether it's been done before, I don't know. So I'll defer to probably Google for that one. But in terms of whether it's possible, I think it definitely is possible. It's really a question of, I suppose, timing and that sort of issue where you've seen central bankers talk a lot about embedded wage expectations. So whether people are, really do want to sort of catch up for that inflation loss. And if they do, I would expect the Goldilocks is quite challenging.
So then when we've talked a lot about inflation, but probably in the context of US inflation, these numbers are hot off the press that Andrew did just before we started recording. And actually New Zealand and Australia don't look like inflation have come off at all, really. New Zealand inflation, December 21, 5.9, peaked at 7.3 and we're back at 7.2. So really we're up near our highs. And I guess this is why we're perhaps a little bit more negative about what goes on in New Zealand, because those rates are really going to have to continue to increase, at least stay at high levels for quite some time to bring that inflation level back down to that target rate. At the same time, you've got, well, what does that affect? It affects everybody's favourite asset, housing, and then consumption and that sort of thing. Is New Zealand different? Why is that inflation a bit more stubborn?
I think there's a couple of reasons. One, in the US, you have the luxury of monthly inflation data. In New Zealand, it is quarterly, so it tends to be quite a long lag. I think the other one is that we are sort of seeing, clearly we have got an economy which has relied on an external labour force or the addition of external labour from offshore, and that really hasn't been available. So you've just got a labour market that is super tight. But I think in some respects, again, it's been interesting that you look across a lot of economic points across really the Western world, and a lot of the dynamics seem quite similar. And if we go back and look at sort of the last year, actually income growth has been remarkably strong. In the US, it's running at about 7 to 8%, and New Zealand's not very different. And if you look at even in the last week, we saw the minimum wage increased. We've seen also superannuation moves up by CPI. So certainly for a decent chunk of the wage earning population, actually their incomes probably have increased by about inflation. So it does mean that spending power is still there, and again probably means if people are spending and consuming, that businesses can say, well, actually maybe I can put up prices a touch. So it gives that sort of impetus as well.
So Andrew, the reason why inflation is so important, because it does dictate where interest rates go, and why that's important is because it has a lot of influence on what happens to risk assets and in this case, the share market. Last year, I think when we discussed things in December, we were relatively negative about shares because of the effect that higher interest rates would have on earnings, and even unrelated to interest rate increases, the economic cycle was that, earnings start to slow down. Coming into this year, and there's talk about the Federal Reserve perhaps pausing interest rate hikes or not going as high as perhaps perceived, although that seems to change on a weekly basis. In New Zealand, the economy is still robust, albeit we've got this stress about property. What is our view on share markets, given what's going on in the inflation environment and interest rates?
Yeah, the share market's had a really positive start to 2023, which is, I think, partially driven by this point you're talking about on inflation. So as inflation heads higher, interest rates need to head higher to try to bring it down. It's the key instrument that central banks around the world use to try to bring down inflation. And in its simplest terms, to reduce inflation, you need to reduce demand for all sorts of goods and services. And when that demand variable starts to reduce, you get that supply-demand mismatch, which ultimately pushes prices down and controls inflation. So last year was all about increasing inflation and increasing interest rates. If interest rates are going higher, generally people will spend less money to own companies or risk assets. And I've said this before on another Monday call, but at its simplest, I like to give the example of buying houses. When you've got a 2.5% mortgage rate, you might be willing to take down $1 million loan or mortgage to buy a house, and you can be comfortable you can service that. But if interest rates double or mortgage rates double to 5%, you're spending twice as much on the interest to service on the debt and in respect to service that debt. And therefore, you may not be able to just buy that sort of $1 million property or take that $1 million loan. And companies are really no different. You've got the same sort of opportunity cost where you might be investing in a company, but if the sort of interest rate is too high on the debt, you may choose to put that money elsewhere. And so the story of 2022 was really about people being more cautious on buying these sort of more risky assets. Also, if you think from an opportunity cost perspective, when interest rates have risen to a level sort of 4% plus in many economies, and you can go buy an investment grade bond, which pays you, say, a 5% yield, you might choose at that point, look, rather than own a company in the stock market, which is paying me an earnings yield of about, say, 4%, I might go buy this bond instead. And that pays me 5%. And that was, if we look at the start of 2022, you're only getting paid about 2% to own a bond. By the end of the year, you're getting paid 5% to own a bond. So just from that sort of weighting between asset classes, that you're more likely to own a bond sort of by the end of last year than you were at the start. Now, what does that mean for this year? Well, I think a lot of the work in terms of repricing for higher interest rates has been done. We've had the the valuation multiples of every share market around the world come back down to more reasonable levels. The United States is now trading at around about the sort of 20-year historical price to earnings multiple. So that's your market capitalization divided by the earnings that the company makes. The New Zealand market's still a little bit expensive versus 20-year level, but it's certainly come back to a much more attractive level. So in other words, you're now buying companies at valuations which are more reflective of the environment we're sort of investing in or living in with the higher interest rates. So that sets up a much more positive sort of positive platform to be able to generate long-term returns. Long-term returns in share markets are around about 8 to 10%. If you look over a 50-year period, when you've got valuations come back to more normal levels, that's a level you can expect to then go on and achieve those long-term returns. I think the other reason that the market's done relatively well this year, or the share market's done relatively well, is that the view on the economy has got a little bit stronger. So last year, as it certainly headed into the end of last year, there was a very large amount of concern from the investment market that this high interest rates were basically going to stall the economy and tip us into recession. Currently, there have been some early leading indicators that economic activity is starting to pick up, particularly in the United States. And so there's a growing sort of theory or growing view from investors that maybe we might be able to get this Goldilocks scenario and miss the recession. And what does that mean? Well, if we don't have a recession, that means the earnings of companies will be better. It means the interest rates, we would be showing that we're at a point where interest rates are not really choking off the economy. Companies will perform better. Risk appetite from investors gets stronger, and generally leads to a higher chance of more attractive equity returns.
And of course, we don't know what's going to happen to the economy until it's already happened, because we get the data after the fact. But I guess it's an important thing to remember that equity markets, share markets are forward-looking. And so at the moment, they're pricing in the fact that perhaps we get away with not as dire economic conditions as perhaps the market thought last year. And that's why we're getting a fantastic rally in markets at the start of the year. I guess what you're talking about, the return from some of those corporate bonds, is a great segue into the second theme, which we're now being paid for owning assets again. And again, Mark, I think you've already written a little bit on this in some of our monthly reviews, if not the one in December coming up and the one for January. But it is a totally different market now for bond investing, isn't it, in terms of what the yield that you can garner from some, pretty ordinary in terms of not bad, ordinary in terms of, run-of-the-mill companies are now giving you a yield that you're pretty happy to take.
Yeah, exactly. And I think, if we go back to the start of last year, we had a situation where asset prices were strange. Interest rates were super low, and they had been for some time. And, you got to a point where the economy had changed and activity had changed, and economies were coming out of COVID. So there needed to be a change in that pricing. And ultimately, investment markets like equilibrium. So when you have a feeling or a market that is out of equilibrium, that's when you get big changes. And clearly the big change last year was the change in interest rates. And nobody really knew how large that change needed to be. Certainly as the year went on, the expectations kept getting increased, in terms of how much central banks would have to do. Clearly we saw that here with the Reserve Bank. And that big range of outcomes creates massive uncertainty, and hence the volatility we saw last year. And so that said very much that last year, I suppose in retrospect, was a year, you can earn an investment return comes in two ways, either through your income, your yield, your dividends, etc., or through your profit or loss, the capital gain or loss. Last year, because you had these really large range of outcomes, it was that capital gain or loss that massively dominated the return. This year, as we look forward, and we've talked about the Goldilocks and the potential for inflation, expectation that inflation is coming down, growth is maybe not fantastic, but it's better. That's a much narrower range of outcomes. So that really says that the markets are much happier. They're closer to equilibrium, and your capital gain or loss component is going to be much smaller this year. So you're likely to get more of your return from that income, from the dividends of the shares or the coupon of the bonds. And in that sense, the nice thing is that both those dividends and those coupons are so much higher, or at least the level you're buying the bonds at is so much higher. Instead of being 2% for a bond, you're buying it at 4, 5, 6, in some cases sort of higher. Those are attractive returns, and in a period where we have less volatility, really to me that says that we're actually paid to own assets, and our default should be to be fully invested and manage around the margin for as the market evolves, but to be fully invested and own assets and really harvest that income.
We talked a lot about it last year when we said the 60-40 portfolio isn't going to give you the returns that it once did. But actually, when we think about it from the bond perspective now, what a great way to generate a yield for a certain part of your portfolio, depending on what your risk profile is. And after an asset class goes through the ructions that it did last year, looking pretty attractive, looking a lot more stable this year. And even if interest rates do continue to creep up or come down, it's not going to be to the extent as it did last year and the year before. And so that stability provides those income assets with what it is usually good for, which is the stable part of the portfolio.
Yeah, well, I think ultimately you could probably call that sort of margin of safety type concept that, if interest rates move higher, at least your starting point is much higher. So you've got more of a cushion to withstand any of those sort of negative interest rate impacts. And, if the world does become a tougher place, interest rates are likely to, revert to their traditional pattern and fall as economies become more challenged. And that is good if you hold bonds at current levels.
And it's not just bonds, is it? Sorry, you go, Andrew.
I was just going to just add one sort of slightly tricky question for Mark, actually, which is around interest rates. And so I said before that it's very likely that interest rate has peaked for this cycle. And when we talk about a cycle, inflation has peaked for the cycle. And when we talk about a cycle, we talk about an economic cycle, which is sort of your boom bust period. And that could be 10 years, it could be 5 years, it could be 20 years. But it's that period where you go through economic growth, and then economic growth sort of starts to lead to a bit of inflation, and then interest rates come higher, and then growth slows down, and then you go into recession. And that's sort of your textbook definition of what the economic cycle is. So the comment I made before, it's likely that inflation has peaked for the United States because it's come off by sort of 3%. But I think the trickier question is, have interest rates peaked for this cycle? And just to, I guess, the lead into the question for Mark is we may see inflation come back from 9% plus to 4% or 5%. But what happens if we struggle to get below that 4 to 5% inflation level? Let's say the labour market stays strong, which it is looking very strong, both in New Zealand and the United States, and wage inflation stays at 5%. Historical analysis will tell you that if wage inflation is running at 5%, it becomes very difficult to get headline CPI inflation down to that 2% level. So how are you thinking about that, Mark? How do you think other investors might be looking at it, and how do we manage portfolios in that environment?
Yeah, well, I think probably I'd first answer the last bit, how other investors are thinking about it. And I think generically people would put that as a very low probability that we see inflation start to rise again. So the market is not pricing that in at present. So that is a risk as we go forward. I think there's ultimately, if inflation does settle, for want of a better word, at 4 and become sort of sticky around that, there are two ways which central banks can kind of deal with that. One, they can kind of accept that their 2% target maybe is not going to be achieved and just chill. I'd say that's probably fairly unlikely. Or two, they've got to continue to push up interest rates to keep sort of, slowing economies at the margin. And it is one of the, I suppose, lower probability. But one thing I'm thinking about is that generally, when you have had big trends break, and clearly last year we saw a 30-year trend towards lower interest rate break and move up significantly, that typically, the pattern is when you get a break of a trend, you get a large, quick move out, but often markets settle down back to that trend before going higher again. So that is something which is a left of field issue which we are watching, and probably getting a bit off tangent, but generally it would seem that central bankers and economists talk about this concept of the neutral rate of inflation. So coming back to that equilibrium idea, neutral rate of interest rates, what level of interest rates achieves that equilibrium level? And it would appear that generally that number is moving up again, after being moving down for a number of years. And in New Zealand, it may actually be closer to sort of a 4% number versus, it was probably 2.5, 3, 2 or 3 years ago.
That exactly described the investment case for one of our external managers, and why we invested with Odie was exactly that it doesn't sound that different between 3 and 4 as your rate of interest rates that you need to bring inflation to sort of normal levels. But it's a huge difference in terms of its effect on asset classes. And Odie has positioned its portfolio to, if it does end up being 4, it will provide, extremely strong returns and perhaps offset some of the negative returns that other asset classes will go through. And so far, he's been right. But, the year is long, and the cycles are volatile.
Yeah, and again, I'll bring in another tangent. I think that one thing we sort of hear from clients at times, but you're talking about these negatives and these issues going forward. It's, reality is there's always issues with financial markets, just like life, I think. But if you come back to that starting point of James said, we're being paid to own assets, and in an environment where inflation has been falling and actually growth is, is sort of not too hot, not too cold. That's kind of the nirvana for a lot of income assets and dividend type assets, because you just harvest those returns.
I always think it's interesting that, myself included, by the way, think about financial markets sometimes as each year, but actually they are, and I've said this before on the Monday call, they are a continuum. And just because you cross a new year doesn't mean to say you sort of reset and things become different. And at the moment, we need to, I guess, play the ball that we're bowled. And at the moment, it seems to be like inflation's peaking, and perhaps interest rates have. But as you said, Andrew, the risk is they haven't. And then at which case you reassess, which is a interesting point on Mark talking about the bond market and the fact that you're getting paid to own assets. But it's also the case for share markets as well, when we think about some of the yields that you're able to get within share markets. And I guess before we jump onto our economic and corporate slowdown theme, where perhaps earnings are under pressure, that maybe some of those yields aren't sustainable. But at the moment, Andrew, the returns that you can get from shares, there's different ways to look at it. As Mark said, there's the yield and there's the capital return. In an environment which is a bit uncertain, we do focus, or like to focus, on companies that have the yield. That's a perfect place to be in the sense of New Zealand has a lot of companies that do pay a yield. But perhaps talk us through some of those differentiators in yield and earnings yield that we're getting now that multiples have come down, that share prices have come down.
If you go back to sort of core principles about what you're doing when you're investing in a company, where you're investing to receive the earnings that companies generate. So ultimately, the value of any company is the discounted cash flows that company is going to earn throughout its entire future life. And so one measure we look at is what is the earnings yield of the company you are buying, and that's simply the net income the company earns divided by the market capitalization. It's actually the reverse of the price to earnings multiple. And it's sometimes good to think of it like this, because people talk about price to earnings multiples of 10 times or 20 times, or what does that really mean? Sometimes you reverse that and go, right, so for this company I'm buying, I'm going to receive 5% of the value I pay for that company in net profit each year. And that's sometimes a great way to think about it. So when we sort of started last year, if you bought a US business, and I think New Zealand was a similar level, you were only getting about a 3.5 to sort of 3.8% yield on what you were paying for that business.
So a lot of years until you got the value back in profit.
That's exactly right. That's exactly right. So it was, relative to history, it's sort of towards the lower end of sort of the earnings yield you would receive. That level now is up around 5% or over 5% in the US. It's slightly below 5% for New Zealand businesses, but that's a level which is much more attractive. You're now almost receiving 25%, 35% more for your investment. It's at a level that's much more attractive. As Mark was saying, you're sort of now being paid to own these businesses. It's also a level which has come up as the bond yields come up. So what you would usually expect is if the yield you could get for owning a government bond or an investment grade company bond goes higher, then generally the equity investors would be demanding to get a higher yield on the equity they own for that business. Otherwise, they may choose to sell that equity and buy the bond. So they need to be incentivized to continue to own the equity. And that's exactly what's happened.
I guess as an aside, when you think about it from a property market perspective in New Zealand, in order to, I guess, compete versus that higher yield, property needs a higher yield as well. And you get that in two ways. Either rents go up, which they can do a bit, but in an economic environment that's difficult, that's going to be tough, or property prices come down, and that's what we're seeing. We've seen Auckland 15 to 20% decrease in property prices. And really that's resetting to the same type of risk assets as shares, where those earnings yields have gone up and property is going to follow it. It just perhaps takes a little bit longer, and the price transparency is a little bit less.
That's exactly right, and a lot of property is financed through debt or leverage. As the cost of that debt increases, then the yield you want to earn on that asset has to increase. And exactly as you said, a lot of that readjustment has been done by property prices falling, including in the residential market. We've had New Zealand housing prices come down by around about 18%. I think it's slightly higher in Auckland, but for New Zealand as a whole, it's about 18% readjustment so far. That is essentially increasing or improving that yield that investors are about to make by letting out residential property.
So theme 3, I think, it's almost the hardest in a way, because it's the bread and butter of the economy, both here and globally, which is economic and corporate slowdown. Basically, that means what's going to happen to earnings of companies going forward. And you've got a lot of headwinds. We've talked about higher interest rates. Companies have debt. They have to pay higher interest rates on their debt. But also with higher interest rates, consumers have less money in their back pocket to spend. And so corporates do slow down. On the other side of things, we've got really great employment statistics, both here and globally, which means everybody's employed, which means people have money to spend. And so it's a difficult one to try and call what's going to happen to that, I guess, corporate earnings growth and the stability of some of these companies. Maybe it means that there are certain sectors you want to be invested in and certain ones that are too uncertain that you want to stay clear of. Andrew, I'm going to give you the hospital pass, and you can start with this one, and then Mark and I will jump in when you've got to the end of your crystal ball gazing.
So earnings is, I would say, from the share market investors or your traditional equity investors, if you put the economy to a side and just think about company specifics, earnings is the number one talked about point in share markets right now. The reason is because earnings are coming off. They are basically declining in every share market around the world. Now, why is that? Number one, it's because earnings rose an incredible amount between around about late 2020 through to about mid to early 2022. The reason for this was that basically companies all around the world, or general companies, were able to put through large price increases. So we had a demand boom for most products, many services. This was driven by the very, very easy monetary conditions, the low interest rates, the large fiscal spending by governments. At the same time, we had we had very tight supply chains. So what that really meant was many companies were struggling to get goods to consumers, but the consumers were willing to buy them. They had low interest rates. They're able to remortgage their houses if they wanted to. We saw it in New Zealand, people buying boats and cars and actually sort of importing, retail, on the retail stocks, or companies like Warehouse had very strong performance because Warehouse didn't need to discount its goods anymore. They usually run a lot of sales, but people were willing to spend, and because they couldn't get a lot of products in, they just didn't discount anything, and they had really, really big, large improvements in margins. And so you saw this right across the spectrum. You saw it from technology companies, which are able to push through price increases for their services. You saw it for retail companies in particular, industrial companies that were struggling to get sort of capital good type products and were able to put through prices. And so just one sort of number for the United States, the sort of average earnings of the S&P 500 companies increased by about 30 to 35% from the end of 2019 to where we got to it around about the end of 2021. So what's happening now? We're now getting the reverse. Inflation is coming down. Demand by general consumers has been waning. I wouldn't say we're in trouble, but it's been decreasing from very high levels. This is because interest rates have got higher and things like housing prices are coming down. People are getting more conservative on how they spend. But at the same time, the cost bases of these companies are now increasing. The number one cost that is really going up is wage inflation. We've finally got this wage inflation running at 5%. And so you've now got a really tough dynamic for many companies out there where they're struggling to put through the prices up as much. But their cost bases are really flying high. So that's putting pressure on margins. Just to give you a quick idea of what that means for the US, because the US is in its Q4 reporting season at the moment. Most of the large companies have reported. The adjusted, or call it the normalized earnings per share of US companies is down 9% year on year. So relative to Q4 last year, they're down 9%. Now, this has been a trend we've seen the last few quarters. It is accelerating slightly as I guess the squeeze gets to its worst point. And so we're seeing similar things in New Zealand, although New Zealand's holding up a bit better, and that's largely because we've got a more favourable composition of companies. If you look at sort of the rough split of New Zealand companies by their style, we would classify about 65% of the NZX 50 as being what we consider more defensive and stable businesses. This is businesses that aren't particularly sensitive to price movements and the economic activity. So this is such as your gentailers, such as Mercury and Meridian. Will include your telecom companies such as Spark. We have companies like Auckland Airport and Chorus, which are large, stable infrastructure businesses. So we're holding up a bit better than the United States, but we're still seeing that pressure.
So that 9% in the US, that's a nominal number, isn't it? So actually you've had inflation of 6, 7%, 8%.
And you're falling.
And it's fallen 9%. So actually your real decline's closer to 15%.
That's right. And I'm not going to get into too much detail on this, but the number I quoted is what's called a normalized number, where companies can sort of normalize their earnings for a few things. If you actually look at the GAP, the Global Accounting Practice numbers, it's down 20% quarter on quarter. So we're really seeing some pressure there. What do we think going forward? This is where it comes back, and I'm sure James will jump in here with some thoughts too, but you have to have a view on the economy. Yes, we're going to continue to get a little bit of this margin pressure, even if the economy stays strong and avoids a recession. But if we do get a recession, history will tell us that those earnings numbers will fall further and faster than where we've got to. So really at the moment, it's sort of a matter of do people think we're going to go into recession? Will we avoid the recession? If we do avoid the recession, I think we see a bottom in these earnings numbers at some point through this year. And when I say a bottom, we're still going to bottom at earnings numbers that were higher than we're earning in 2019. So we're really just taking off that cap that we're sort of over-earned by. So in that sort of situation, it's not necessarily a particularly bad outlook for corporates. They're still earning good numbers. They're still earning a nice run rate level of earnings compared to what they were in 2019. If you take a more negative view on the economy, then I think we could see some declines in earnings to below the levels we earned in 2019. Now, if that happens, it gets very important about which type of stocks you want to own. Just because the overall, for example, a lot of companies facing pressure doesn't mean we have to have large exposure to those companies. We can rotate our exposure to the more defensive companies. As I said, the New Zealand market's not a bad market to be in this situation. Nice defensive companies, but even when you look at invested in Australia, you can own companies such as we've got a positive outlook in commodities, which we'll get to, but we can own commodity companies. We can, United States, we can buy, technology companies that aren't particularly exposed to sort of economic pressures, and there are a number of those out there. We can also own defensive companies there. We can buy, if we want, telcos and utility companies and infrastructure businesses in the US. So you've got a lot of options as an active stock manager to try to work through this environment.
I think two thoughts on that, Andrew, and your summary is sets out exactly, I think, what the market's even trying to consider at the moment. First comment would be that this is why we are doubling down on our fundamental research, because I think there's going to be some shares and bonds in the credit space that look super interesting in this environment. Yes, the wider economy might be slowing down. Maybe it slows down further, but some of these companies either do well in that environment, are immune from that environment, or for whatever reason, be it they are just at a different phase of their growth cycle where they can sort of almost ignore economic conditions. And we've been doing a lot of work. I know the analysts in our office have been pumping out some pretty high velocity research, and every stock that we're looking at has some really interesting attributes going into 2023, both from a more traditional utilities infrastructure space to right through to, like you said, some of the growth stocks. I know we did a big session on Friday on Adobe, which I think most of us will agree that there is some technology spending cuts going on in economies at the moment. But if you are going to cut your technology spending, most people are probably going to keep their Adobe subscriptions, and perhaps they can actually just gain market share as people drop other forms of that sort of product. That's one thought. The other thought as well is it's amazing how forward-looking shares are. I remember in March, April 2020, when we were not in this flash recording studio on camera with headphones, but
it was a garage somewhere, wasn't it?
Yeah, it was a garage and on a pretty rusty internet connection, talking to everybody on this call and trying to bang the table that, yes, the economy is under pressure because of COVID and everybody's locked at home, but this is the time and the place to buy shares given how forward-looking they are, and trying to reflect the fact that shares looked really positive because of the amount of capital and monetary policy and things being pumped into economies. This is sort of the opposite, but the same. Looking at the returns of 2022, S&P 500 down 18%, NASDAQ down almost 33%, New Zealand down 12% in 22, but that's after a more difficult 21 as well. The only sort of shining light is the ASX, which was almost flat for 2022, which is heroic in its own right, and maybe we should have a whole session on that. But I guess what I'm saying is that you've got all these earnings pressures, but perhaps that's one of the reasons why markets were down so negatively last year, and have they done the hard work of resetting for a slower economy or an economy that's going into recession? Now, I don't know the answer to that, but that's the hard but awesome thing about equities, is they kind of don't care what's happening now. They care about what's happening in the future. And that's, I guess, where we're going to focus on, isn't it, from the equity side, is what do we think companies are going to earn going forward, given everything that's happened to date, and maybe we can find some value there. And actually, if we can, Adobe, we're not buying Adobe at the moment. We're researching it, and maybe we come out negatively, maybe we come out positively, but they're still 60% lower than they were at the start of last year. And so you're buying a company that's 60% cheaper in an environment that maybe it is quite good for them.
Yeah, and I think exactly what you're talking about, James, is part of the reason share markets have had quite a strong start to 23 this year. So I didn't give the numbers actually on returns so far. This is to 10th of February 2023, but the S&P 500's up 7%. The NASDAQ, the more technology-focused component of the US, is up 12%. New Zealand and Australia are both up about 6%. So it's been a fantastic start to the year for share markets. And in normal times, you expect an 8 to 10% return from a annualized in share markets, and we've almost done that return in some markets. And so that's certainly reflecting a more positive outlook. And I think exactly what you're talking about, James, even though the Q4 earnings data in the US has been a bit weak, I think what investors have been doing is have been looking forward to some stronger economic outlook data points. There's been a number of data points in the US, which is indicating that we're starting to see a little bit of improvement in economic activity. And I think the market's going, well, I know earnings is quite weak this quarter, but if we continue to see this sort of stabilization in the economic activity, that's ultimately going to be supportive for corporate earnings. And I'd just like to give you one example. We mentioned some technology type stocks that might perform well. An example of a business that we own and have talked about on these calls before is Uber. Uber's a business which was loss making going into 2020, 2021. And they made a huge strategic move on that business to become profitable. That company now earns about $600 million of earnings before interest and tax and depreciation a quarter. So they're doing well north of sort of $2 billion of earnings a year now, and that's improving at an incredible rate. And so just because we say the market as a whole has got earnings pressure, it certainly doesn't mean every company does. And Uber's shares are up, I think, around about 40 or 45% so far this year. And that's really reflecting that movement from investors to finding the companies that are actually improving earnings in this environment rather than under pressure.
It's also the school C maths I always remind myself of. Is when markets were down, and I'm going to get this math wrong now, but if markets were down 20% last year, they might rally 20% this year, but we're still well down from where they were. And so they've still taken into account a different economic environment from the one that we had in 21. But they've sort of recovered somewhat because of forward expectations. And so you can have quite profound jumps in share markets and great individual year share market performance, but still those markets are taking into account the fact that things are a bit tougher, and so they're still down as a whole. And so what we have to be really careful of is missing out on those retracements, because we're here to invest in equities over the long term for our growth portfolios, and we need to be invested. On the other hand, last year, specifically the beginning of last year, Andrew, we felt pretty good mitigating that downside when markets were negative through a whole lot of different catalysts. And we're certainly going to be focused on, if we see clouds on the horizon and share markets coming under pressure, making sure that we implement our downside mitigation to absorb that decrease, at the same time being invested to make sure that as share markets, I guess, absorb the new normal, we continue on that journey upwards. The last theme is sort of dear to my heart, both in a really excited about, but also it's dear to my heart because it's probably the one that provides the most difficulty when thinking about financial markets because of, I guess, the volatility in this asset class, and that is commodities. Now, after 3 years of lockdown, China is finally reopening, and some of the team, when we talk to our contacts in China, they're talking about a huge bounce back in demand for flights and aviation, and even property is doing a lot better than it was, and that really spurs on that commodities rally that we've talked about since 2020, 2021? I can't remember the years now. It's all sort of molded into one. But I think that it does provide some exciting opportunities to differentiate our returns, given that we're not out of the woods yet on inflation, and inflation has a lot of wood to chop to normalise. And one of the biggest creators of inflation is commodities. And Andrew, maybe first thing you could do is take us through the returns that the commodities index did last year when we think about that versus the market that was down almost 20%.
Yeah, that's a good place to start, James, because commodities is, to some extent or in many extents, a very differentiated return asset class from bonds and equities or bonds in the share market. And that's because commodities is a supply and demand product at its core. It is, you pay more for a product if you cannot get the supply, and the prices will go up. And that's exactly what happened in 2022. So the Bloomberg Commodities Index was up by 14% in 2022. points throughout the year. It was up about 30 or 40%, but it finished up 13. But that's, in a year where most share markets were down 20% and many government bond markets were down around 10 to 15% as well. So, from a differentiation perspective, it was a very, very good year. What drove that? Well, we had Ukraine war kicked off, which provided a very strong start to it. We had improving demand in some economies. We sort of had that sort of like low interest rates driving demand, so that provided a boost, particularly in the United States. But then that was a little bit offset by China still being locked down, so we had some push and pull factors from the demand side. But I think if you step right back, why has commodities been an upward trend for the last couple of years? It's because we didn't invest in commodities for a decade. And I'm being a little bit simplistic by saying didn't invest, but what I mean is we underinvested in replacing the production capacity of many core commodities over the last decade. Now, why have we been underinvesting? Well, commodities go, like most things in investment markets, in cycles. You have periods where prices go really high and periods where prices go really low. And what tends to drive periods, and when I say periods, sort of decade-long periods of high prices, is when you have a big structural shift in demand for commodities or for supply of commodities. Now, it tends to be more around the demand. So when was the last period of really strong demand and high commodity prices? It was through the 2000s, and that's when China, not just China, but China and other Asian countries and South American countries such as Brazil, went through a really large period of economic expansion and also became much more willing and able to trade with the Western economy. So China just really launched itself into the global trade market with huge economic growth. They demanded all sorts of products such as oil and copper and iron ore, aluminium, key economically sensitive or cyclical type products, and that drove a big boom in commodity prices. I won't go into too much detail, but a couple of other periods of high prices were 1970s and 80s. Throughout the period of the Vietnam War, we saw prices really high, throughout the World War II period and just post the World War II, when sort of all the countries were sort of stimulating to try to recover from the war effort. You can go right the way back to 1700s and 1800s throughout periods. It tends to be every sort of 20 to 30 years you get big economic upswings. Now, this one here is a little bit different. What we're talking about now is because we actually had a fundamental undersupply or investment, because when prices got really high in the late 2000s, a lot of sort of mining companies or resource companies would have built more capacity. Of course, they overbuilt that capacity, and then there was too much supply of copper and oil. Prices fell to very low levels, and so basically no company has been incentivized to invest in building new capacity for the last 10 years, which means they have now underbuilt capacity. So now we don't have enough supply. And
that's not really changing either in some respects, is it? I heard something the other day that last year was the lowest year for new announced copper capacity in something like 20 years.
And it's amazing because copper stocks are now at one of the lowest levels we've seen over the last 20 years. And it just blows my mind that we're still not really getting that reinvestment. From an oil perspective, even though we've had higher oil prices, companies are still very cautious about adding large capacity. Part of that's ESG, environmental type constraints. Companies are being more careful about how they invest in.
It's not like it's not like they're not earning enough. Looking at some of the results from BP and Shell,
they're definitely earning enough money to reinvest. I think it's just caution. They've gone through a 10-year period where they earned very poor returns. Investors would rather see them be cautious and just sort of, pay some dividends out, earn some good cash and pay it out as dividends rather than go and reinvest in more capacity. And I think for the next 10 to 20 years, and anything that's related to the green transition is going to be fundamentally supported from a demand perspective. So key products there are copper and aluminium, which are incredibly important in the green energy transition.
I guess overall, we're really excited about the space. I think the copper example, Mark, you gave is a wonderful one of how to get access to, one, the regrowth or the growth of China coming out of COVID, but also more longer term. It is a theme that we think will provide a differentiated and strong return. it just is different from the market. I know the last few weeks have been tough in the commodities market, and it's nothing to do with commodities really, and it's one I'm going to throw at Mark in a second. He doesn't know, but it's more around currency. But that commodity cycle is a long-term one. The way that we get exposure is a lot more nuanced in the sense that we use options to make sure that we get that good upside, but restrict or, I guess, contain the downside. But it just does mean that on a month-by-month basis, sometimes our performance will differ because we've got a commodities exposure. But it's unapologetic because we think that if inflation does stay high, if there are difficulties within the economy, that commodities market will be able to create a return that will continue to help us generate that 8 to 10% return for growth assets, which is what we're all after for that long-term return. I know I didn't warn you about FX, and it's the bane of our life at the moment in terms of the volatility in FX. But a really interesting one, I guess, in terms of the US dollar was persona non grata last year or end of last year.
End, yeah.
It was the king, and then it wasn't, and now it's really racing back. And do you want to just make a couple of quick comments on what's going on with the dollar?
Yeah, I suppose the very high-level comments, a lot of what happens, I think, clearly we're focused on what happens to Kiwi, and most New Zealanders are. A lot of what happens, or I shouldn't say a lot, actually most of what happens there is not related to New Zealand, it's related to the US dollar. The US dollar was remarkably strong for most of last year, and then as you saw that period of, interest rates are not going to go as high as they would need to be, it came back quite sharply, and Kiwi was up over 10%, from the lows at 55 up to 65. We do look like we're going through a period of a bit of US dollar strength again as the market starts to think about stronger growth, and maybe interest rates need to percolate a bit higher. But again, against that, I think I'm going to sit on the fence and say, well, in a world where carry, that sort of income does well, New Zealand dollar is typically a higher yielding currency, so it should do relatively well. But at the same time, have headwinds from the US dollar. So I'm probably an unched type response of Kiwi or somewhere between 60 and 63, where it is today, is probably where I'd expect it to be.
And there's positives and negatives about a stronger and weaker Kiwi. Stronger is good for, I guess, travel and imports, but that whole milk powder price, which is really important in terms of our dairy and export, agricultural exports, does a lot better when Kiwi's weaker. So it's not all bad when we get that weakness. That's been a long session, and because we have tried to go over across all the asset classes that we're thinking about. What we're going to do for 2023 is be much more focused on the investment markets and how we're positioning portfolios within each of those markets. And so the reflection on some of the feedback we got last year was continue with our fantastic guests that we get on. We've got some wonderful guests already booked in to talk to us about their businesses and their what they do within the economy or political landscape. But let's also bring it back to what's going on in the portfolios. How do we get exposure to those asset classes? Why do we have exposure to those asset classes? And what we think those asset classes will do in terms of returns in the portfolio. So you might be seeing a lot more of the three of us this year, which is a good thing or a bad thing, depending on how you think about things. But we're also really excited about sharing our views and our positioning with you in the portfolios, given, as we've talked about, there's a lot to talk about. There are a lot of things in the economy that are uncertain, and we want to be able to hold your hand through this uncertainty because we think the opportunity set, both in the growth assets, but also now the income assets are massive. And we think that the ability to generate some strong returns this year are right there. And we're going to work together with you to make sure that we are able to generate those returns and look forward to sharing how we're doing it and why we're doing it into the rest of the year. So on that, thanks, Mark. Thanks, Andrew. We'll see you again soon. And thanks, everybody, for listening. Stay safe out there, especially those in the North Island, and look forward to speaking very soon.
This has been the Monday Call, brought to you by NZ Funds. New Zealand Funds Management Limited is the issuer of the NZ Funds KiwiSaver scheme, the NZ Funds Managed Superannuation Service, the NZ Funds Advised Portfolio Service, the NZ Funds Wealth Builder, and NZ Funds Income Generator. A product disclosure statement for each is available at nzfunds.co.nz. Past performance is not necessarily an indicator of future returns.